Let me start my story of risk and renaissance in global energy markets with a story about a building or a set of 10 buildings that kind of act as an emblem for what I want to talk about at the end of my remarks, which is how we dig ourselves out of the mess that I and many people like me think that the energy industry is creating for us. So these buildings are just outside London. They're low-income housing. For those of you who are multitasking, this development is called Green Watt Way. Green Watt is all one word. And the housing was built recently for low-income workers of one of the big 6 utilities in the UK, SSE, a kind of British equivalent of Southern California Edison, one of the big US utilities. It was put up in just a few months, really rapid construction. You can see that construction in time-lapse photography on the website. And those buildings are beyond zero carbon. So the roofs are all solar electric, solar photovoltaic roof tiles that my company manufactured and installed, Solar Century. And they provide way more electricity than all the occupants use in the development. Plenty left over to charge the community battery car for going down to the supermarket. So there's a transport link to this as well. And you might be thinking, okay, electricity is easier to do than heating. What about the heating? Well, all the heating in this development can be and is provided by any one of 4 separate renewable energy technologies on site. I won't run through the technical details. I'll just try and intrigue you enough in this development to make you want to go and have a look at it. But here's the thing, you know, for people like me who are clean energy entrepreneurs on the front lines of what we can do with the full family of maybe 50 groups of clean energy technology, mixing and matching them, it's very frustrating sometimes to think of what we see on the front lines and yet the huge obstacles that are put up to cutting emissions internationally and nationally. Though that development requires no coal, no gas, no oil, no nuclear. The residents in the development pay virtually no energy bills. And it was put up in a matter of months. I emphasize that when you look at some of the big incumbency energy projects in fossil fuels and nuclear and consider these days how much time they take generally to put in place. So I'll leave you with that thought and move to the nature of the problem. And I'm going to go through the categories of risk that I have seen working in the energy industry. And there are 4 of them that I want to talk about. I'll talk a little bit about climate, not much, because with an audience like this, giving up your afternoon on a fine day, you've heard enough about climate. You know that's why you're here, basically, I think most of you, I'm sure. But I do want to talk about the risk of a carbon bubble and work that's going on in the City of London and on Wall Street and elsewhere to look at risk that isn't recognized in the capital markets that many of us now think can be used to really turn this drama around. Personally, I think after a quarter of a century of working on the climate change issue, that this particular risk theme is something that could actually be the game changer, the thing that swings around the world we're in at the moment, which is a world, as you know, on the way to 6 degrees Celsius of global warming, to the place we need to be, which is a road where we don't go above 2 degrees Celsius of global warming and live with the benefits of a stable climate, or at least a climate that's not melting down on us underneath that widely recognized danger ceiling of 2 degrees Celsius. I then want to talk about other systemic risk issues that I've seen building, with my background being once one of them, as it were, in the fossil fuel energy incumbency. I tend to get invited to contact sessions, discussions into fora, often behind closed doors, where I see the energy incumbency wrestling with the problem of climate change and some of its other issues. And I've watched this systemic risk-taking build within the energy industry in a way that reminds me really in a fundamental way about the financial crisis. We've all lived through this financial crisis. It started here in the United States, and just to remind you of the highlights of that, it was an issue really of risk-taking involving catastrophic miscalculation of the worth of assets. In the case of the financial crisis, it was mortgage-backed securities, complex derivatives thereof, and we all know the basic drama. We were insured by an incumbency, the financial sector, particularly the investment banks, that what they'd uncovered with mortgage-backed securities was a risk-free or very low risk route to a new way of generating wealth. Most of us accepted that narrative. I know I did. I wasn't paying attention particularly, and I have some financial expertise to offer here. I've been on the board of a private equity fund run by a Swiss bank investing in renewables for more than a decade. So I saw this drama of the financial crisis unfold from within a Swiss bank's boardroom, if you like. So most of us were taken completely by surprise. There were some whistleblowers, interestingly not within the incumbency. They were economists, maverick economists, some of them admittedly with Nobel Prizes in economics, and they were far-sighted financial journalists, people like Gillian Tett at the Financial Times, warning that this narrative was fundamentally flawed and that this wasn't a risk-free route to nirvana and new wealth. This was actually a toxic bubble that was being inflated in the markets that was going to break on us. We all know who was right in that little exercise. And of course, the financial incumbency took the world economy right to the very edge. It could have been a complete Armageddon situation. As it was, governments got together under the gun, really under pressure, and arguably put in place measures that saw off the worst of that crisis. Some of you might be thinking, well, actually, only temporarily, and you could be right. But in any event, they did act, and they arrested some of the more disastrous possibilities. So that is the backdrop to what worries me and people like me so much now about the behaviors we're seeing in the energy incumbency. The climate risk-taking is a classic example, but there's also the possibility that other narratives that were being spun about wealth creation are going to turn toxic on us as well. And I'll talk a little bit about the shale boom here in the United States and how it might continue out into the world. Some of us worry, a minority, I have to admit, worry that that narrative is actually flawed, and it's another one of these bubbles that we're very good at creating. And then finally, I'll talk a little bit about oil supply, where again, we have a narrative of plenty from the incumbency. And that narrative says, there's plenty of oil, we can go off into the future and we can provide as much oil as global society needs, even decades into the future on the current rising trajectory. And there's a minority of people who doubt that narrative as well, of which I'm one. And the interesting thing about this minority, unlike the financial crisis, is that there are people within the energy industry who are blowing whistles, in some cases still in place in oil companies, but particularly there's a tendency for people who've just retired from oil companies to be blowing the whistles. I've noticed it's quite interesting in that regard. So let me start with climate change and work my way systematically through these issues. So not much to say here, but just to remind you of the drama. It often, to some of us, feels like a civil war because you've got two really different belief systems. And let's take two companies just as examples of just how different they are. let's take IKEA and Exxon. So IKEA fully buys up to the risk story that is being told by the vast majority of the world's climate scientists in multiple countries, many of them, of course, in government service in places like NASA, the Meteorological Office in the UK. So IKEA's response to this is a big problem. We don't want to have anything to do with this. We want to be a leader in dealing with it. And so what's their objective? To 100% renewably power all their stores in 35 countries by 2020, just 6 years from now, mostly with wind and solar. Not all on site, obviously, but with a green electricity moved in to the stores. So that's leadership in the retail sector, the best of class. What about Exxon? So Exxon, to remind you, some of you will have seen their recent report, but basically Exxon has given up publicly arguing the toss about whether we have a threat and whether the scientists are right. Of course, they still privately fund all sorts of conservative think tanks and lobbying organizations who deploy smoke screens. We all know this. It's reported on quite regularly in the media. But Exxon's take on all this is the risk to our business is precisely zero that policymakers will ever do anything about this in terms of policies in place. And therefore, we're not going to do anything. You know, we're only going to react if society tells us that to do something. If it doesn't, which we don't think it will, we don't think there's any risk it will, we will just keep going with what we do and what we do well, which is go off and find oil or gas. So two end members, if you like, to represent the drama. And in terms of money, and a lot of what I'm going to be talking about involves money, billions and trillions of dollars, it's interesting to think what we would have to do in order to prove Exxon wrong. Never mind about the policymakers, just think about the patterns of money, the money flows. Right now, in round figures, the amount of investment going each year into clean energy, mostly renewables, but also energy efficiency, is about $250 billion, $250 billion. Our partner in Carbon Tracker Series has calculated that in order to keep below this 2 degrees safety ceiling in climate change, what we would have to do is lift that level of investment by 2035 to $1 trillion a year. So that's just an increase of $750 billion in order to do that. And when you consider the full enormity of the global capital markets, it doesn't sound undoable by 2035. So incremental increases every year in the amount that would be invested to get us to $1 trillion. And just to give you a feel for scale, there's one story that you might have read about, and if you haven't, I commend it to you. It would be funny if it wasn't so hilarious. It's one of the capital expenditure projects of the oil industry. It's in Kazakhstan, and it's called Kashagan, or as the oil industry practitioners involved in the project have started to call it Cash All Gone. This was an oil field, one of the biggest ever discovered in 2000, and at that time the oil industry thought it would take $10 billion to develop it. A lot of money. So they all got in together, Shell, Exxon, Eni. Now, more than 10 years later, that oil field produced a bit of oil for a couple of weeks and then had to be shut down. It's going to be shut down for 2 years. The full capital cost deployment for that single oil field is now $50 billion and counting. The problem was the oil coming up the pipes was so acidic that it started eating the pipes away. The whole thing has got to be redone top to bottom. It may never open. These are guys, I speak, having been one of them once, that really don't know how to stop once they start on something. There's a cultural thing here. The average age in the oil and gas industry is 49 years. Most of them are men, of course. And I speak from personal experience and also stories told to me by my friends who still work in the industry. There is a deadly cultural machismo in that industry, they won't stop, even on that potential white elephant, unless investors tell them to stop. But that kind of $50 billion story gives you an insight on the $750 billion that we would have to raise across the piece in 50 families or more of clean energy technology in order to have a really good chance of fixing this problem. So I think I'm going to sort of leave climate change there, move on to the issue of the carbon bubble, which is related but is a financial issue. And this is a very interesting story because for a long time, really since 1990, environmental groups had known that there's way too much carbon in fossil fuel reserves that we could burn underground, you know, if we want to stay below 2 degrees Celsius. This overhang, if you like, this amount of unburnable carbon really is not a new story. It's been going for the longest time. What we didn't do, those of us who knew about this and wrote about it, is put it in the language of the capital markets. And we had to wait until 2011 for the first set of players to do that. This is the Carbon Tracker team, which I have the great privilege of being the chairman of. And it's a group of renegade investment bankers and financial analysts who are worried about climate change, motivated by climate change, and in some cases have left their cozy jobs in investment banks to work in this small think tank, who actually took this story of the unburnable carbon and turned it into the language of the capital markets. And the calculations that we did with our colleagues showed that roughly 80% of all the proved reserves, not the resources that would be turned into reserves by spending more capital on going off and exploring for reserves, but the existing reserves, 80% of them could not be burnt, would have to be left underground if we want to stay within the 2 degrees ceiling. Most of it coal, but also a lot of oil and gas as well. And in the first Carbon Tracker report in 2011, for the first time, this was all quantified stock exchange by stock exchange, and also in terms of the top 200 oil, gas, and coal companies. And immediately, it began to resonate with the target, which was the investor community. So this report was covered 6 times in the Financial Times, in different ways, after it was published. And I could tell that it was going to get traction in a way that many of the arguments hadn't up to that point. The second report came out in May of 2013, was launched in Bloomberg's palatial London headquarters, and this dived in a bit deeper and looked at the CapEx, the capital expenditure that would be needed to be deployed in order for the oil, gas, and coal company to keep going with the replacement of their reserves, the growth of their reserves, the growth of the supply of fossil fuels to the fossil fuel addicted global economy. And we totted up the 2012 figures for CapEx, and they came to $670 billion. So as you go through this talk, you can sort of juxtapose all the billion examples of tranches of billions, 670 billion. Mostly to be spent on taking resources, turning them into reserves. Some of that money also to be spent on existing oil fields to make sure that the production stays up at the levels that the industry has been projecting. And that report, I always knew that it was going to have a big impact, but I didn't, I think, fully understand that it could be a game changer until the discussion in the Bloomberg headquarters. And we had a panel of investment bankers there and analysts talking about the report. And one of them was a gentleman called Paul Spedding, who was then head of oil and gas analysis at HSBC. And he said, and here I paraphrase, but accurately and fairly, I hope, he said, you know, you can't question the arithmetic of this problem that we have with the carbon bubble. Is being inflated all the time with the capital expenditures that are being planned by the oil and gas industry. And what I should be doing is going from this presentation back to my company, HSBC, and advising our clients to tell the oil and gas industry not to waste their money on the CapEx and give it back to us as dividends. The dividend flow in the oil and gas industry is much lower than that. It's about $120, $130 billion a year. And at that point, I thought to myself, well, okay, that's just one analyst in the oil and gas industry, but if all the analysts in the oil and gas industry start saying that to the oil industry and shareholders start putting that pressure on, then these people no longer have viable business models. They can keep going for quite a time, but they'll be shrinking their asset base. They'll be giving their cash flows back to their investors. They can't do that in perpetuity into the future. That means they just have no way to grow. So what's happened since that report came out, he was only one analyst. Others didn't take that line, but the pressure was there nonetheless. And for those of you who follow the financial pages, you can see that this is one of the big pressure points in the oil and gas industry right now. Classic example, Shale, who are perhaps the most adventurous frontier country. They're the people who wanted to go into the Arctic first and drill for oil. You remember the stories from last year. Their very first expedition with a drill rig into the Arctic, it ended up on the rocks in Alaska. You remember that? But now they've had to cancel their entire drilling operation in 2014, in next year, and say to their shareholders, yeah, we hear what you're telling us. We will start giving you more money back as dividends, and that's the situation for next year. If it keeps going for the year after that and the year after that, then they truly have a huge problem. So this is the major pressure point, but it's not just capex, it's also divestment. And you will all have heard, I think, of the divestment campaign that's being run by 350.org and others, and they too are having successes, most notably just the other day, Stanford University divesting from all its coal investments. But it's not just universities and pressure from kids on campuses. It's also big funds are beginning to move in this direction. So Storebrand, Norway's biggest insurer, has pulled out of more than 30 coal and tar sands companies, saying that it's doing so because of the risk of carbon asset stranding. One of the Swedish state pension funds, AP4, has also pulled out of all fossil fuels, citing the carbon fuel asset stranding risk. Local government, super big pension fund in Australia has done the same, and I think most importantly, there really are mornings these days when I open up my laptop and look at the news of the morning in the Financial Times or wherever, and I have to pinch myself to check that I'm not still dreaming and asleep. The other day, BlackRock, the biggest fund manager in the world, announced that it was teaming up with FTSE to provide an array of options for its investors that will be completely devoid of fossil fuels. So you think, where is this going? This momentum that's come just in the last year or so, it's almost come out of nowhere. If it keeps on this trajectory, there really will be important pressures on fossil fuels on the issues of capex. So now what about shale? So we have another happy, clappy incumbency narrative there. It's being played out in this country. There's a boom, and there have been manifest economic benefits from the fracking frenzy that has been going on out there in the interior of the country. Well, also in Pennsylvania and the intention in New York as well, of course. And there's no denying this has been a boom. It has brought down the price of gas. It has had economic benefits from America, for America. But there are two issues here. First, is it sustainable? Can it be kept going? Is it a short-term thing, another bubble of the kind we're so good at blowing up? Or will it, as the incumbency says, keep going off into the future, maybe decades into the future, on a rising trajectory? That's the first question. The second question is, even if it is sustainable financially here in the United States, is it exportable to the rest of the world? Let's take those two in turn. Regarding what's going on in the States, very few people sort of follow the patterns of play in detail in these issues. The neuroscientists tell us that we tend to quickly slip into belief systems. Neuroscience has undergone an explosion of discovery in the last 10 years about how the human brain works, individually and collectively. And they have a rap that goes like this: we are predictably irrational. We tend to be predictably irrational as individuals and as groups of people making decisions. We really favor comfortable narratives over uncomfortable narratives. And many of us, under pressure, if we're faced with an uncomfortable narrative, will actually invent a comfortable one if we have to. All this is based in very large experimental data sets, and one of these explosions that happen from time to time in scientific disciplines. So that's a challenge when you get to appreciate what they're discovering and how unsurprised they are by things like the financial crisis and some of the dramas in energy. But it's also a bit of an opportunity because they're discovering other things as well, which is that we tend to love community, that we abhor violence, and there's even a strand of thinking that we are getting more empathic as time goes by. That Jeremy Rifkin does very good line on this. That as time goes by and as we enjoy technological breakthroughs like the digital revolution, we connect more, we tend individually and collectively to be more empathic. So there are things to work with as well as problems to be aware of in looking at these ways we behave and how they connect into bubbles. So back to shale. If you begin to look at the detail, as I and people like me do, scratching below the surface a bit, you immediately start seeing flaws in this narrative. Let me give you just a few without getting too technical. There are a number of what they call shale plays around America, regions where shale gas has been produced, is produced, also shale oil from the fracking process. If you stack up production from all the shale gas plays except one, that's about 8 or 9 major shale plays, and you stack up their production on top of each other, you see that it's already peaked. It peaked last year and is beginning to descend. The thing that keeps it propped up nationally is the Marcellus Shale, the big play in Pennsylvania that comes up the East Coast here. And there is a school of thought that that too is under pressure because of the rapid drop-off rates in production that are a geological feature of all these wells. Then there's the financial sustainability of the shale boom. And recently, a report was produced totting up all the losses, all the written-off assets of the top 15 oil and gas players in US shale. If you haven't heard this figure, it will surprise you. $35 billion of assets written off. This is not a game that is producing money for the oil and gas industry. It's producing money for Wall Street, but not for the oil and gas industry. Bloomberg produced a report the other day totting up the costs of the drilling. They're drilling at a cost for both oil and gas of around $1.50 for every dollar that they get back in cash from the oil and gas sold. As one of my colleagues calls it, this is not a boom. This is a retirement party for an entire industry. It has to turn around. Otherwise, companies are going to start going bankrupt. Again, this machismo thing, if we don't know what else to do except keep drilling and keep going with this addiction to fossil fuels. So let's leave America for a minute and assume that the price does go up and that the industry does survive and it is sustainable and that America can actually begin to export shale gas. That may or may not happen. I don't think that it will. But even if it does, then what happens overseas? And here you have a whole panoply of issues in countries where it becomes very difficult to envisage this short-term boom being replicated in any way. It varies country by country. So Poland obviously would be desperately keen for shale gas to get away from the yoke of the pipelines that come from Russia. Very clear. So they're very keen on shale gas, but their shale it doesn't look as though it's of the quality, anything like the quality of US shale. Exxon drilled only 3 wells in that country before pulling out. In China, it looks as though water could be a big problem. So you be aware that this is a very water-intensive process. There are whole towns running out of water in Texas because they sold their aquifers to the contractors, the fracking contractors. I'm sure you read about this in your papers. What about China? You know, the fracking process is going very slowly in China, and there's no doubt that big questions are being asked about water in that drought-prone country, and so it goes on. In my own country, the United Kingdom, that small island, we do, it seems, have good shale, but we also have a very tightly packed and extremely conservative rural population. And the first well that the industry tried to drill last summer in the south of England was greeted by 3,000 protesters at the gate when they tried to deliver the pipes. You should see the pictures if you haven't seen them already. Many of them were people who'd never been on a demonstration in their life, clearly. And this is the first potential fracked well. You've all seen the aerial pictures, what a sweet spot looks like in Texas or North Dakota. You imagine superimposing that on the British countryside. Conservative voters will be dying in ditches to stop it happening. And I quote a conservative politician using those words. So what will happen with shale? Will the incumbency narrative continue? I think if you believe people like me, it won't. So finally, oil. And here too, there is a narrative that we have plenty going off into the future. But if you look again indeed just below the surface, you can see really worrying pieces of information, and including from places where you wouldn't think people would be blowing whistles. But the International Energy Agency, an agency run by governments essentially to promote fossil fuels, is one of these. And if you look at its most recent report, you can see a very clear statement that conventional crude oil peaked in production at 69 million barrels a day. We live in a world that's consuming 91 million barrels a day. So most of that production is conventional crude. This is the light oil, the type of oil you see on the rocks when tankers hit them. It has peaked already. And on projected rates of descent of conventional crude, by 2035, wait for this, if you haven't heard this, you will be surprised. We descend to 10 million barrels a day of production from those fields without any deployment of CapEx. If the industry deploys the CapEx it wants to and projects to deploy by 2035, that will go up to 38 million barrels a day. But that steep descent, this is the driver of what people like me fear for the future of oil supply, because that all has to be replaced by all this weird stuff from the tar sands and from the Arctic and from the deep salt under Brazil and from that place in Kazakhstan that I just told you about, where all the oil is so deep and so acid that it sort of destroys the drill pipes. This is what the industry will have to replace all that production with to go up through 95 million barrels a day, 100 million barrels a day, and the rest of it. And they swear blind they can do it. They stick their hands on their hearts and say they can do it, and that people who doubt otherwise don't understand the oil industry and are scaremongers. This is what we get called. Just like Lehman Brothers and Goldman Sachs called the whistleblowers in the run-up to the financial crisis scaremongers who don't understand investment banking. And then you all saw on your television screens what really was the case. Well, CEOs with their hands up in Congress saying, we didn't understand what complex derivatives were either. So this is a gloomy picture, and I don't want to finish without a note of genuine optimism that I do honestly feel in the face of all these threats. It won't surprise you to hear that I don't think that energy policy is going to be defined by sensible, rational, evolutionary policymaking. I think that given this this failure of another great industry to be honest, open, and culturally aware of its systemic risk-taking, I fear that policymaking is going to be crafted under the gun, in crisis, in energy crisis of one form or another, within just a few years. That's the bad news. It's going to get a lot worse before it gets better. But out of that will come two things. The easy and obvious answers to really rapid mobilization of solution and survival technologies under great pressure in society is an option. It's there. I can't tell you that that's what will happen. It's very easy to erect a kind of dystopian vision of the future based on the fabric of society coming under such pressure with these energy issues, given the importance of energy, that everything collapses and we face a really ghastly downslope off into the future. But what gets me out of bed in the morning is this frontline experience of just what we could do under the gun. And I'll give you a few examples of that just to close my remarks and try and interest you enough in this issue to, frankly, if I may just may have one plug for, like, you know, most aging men with a bee in my bonnet. I have a book about it. It's called The Energy of Nations, and I'll leave it at that. There's a lot more detail in there for what I've been talking about. But the examples I would offer you are, first of all, what's happening in Germany. Despite all the setbacks from the energy incumbency, the growth of renewables in Germany, particularly solar and wind, is remarkable. Germany has come from nowhere in relatively few years to produce more than a quarter of its electricity from renewable energy. That's rising all the time. There are days in the middle of the day when 60% of all German electricity is coming from renewables. And if you believe that electricity is likely to be the primary fuel of the future for transportation, and the American company Tesla is a very good example. If that's the kind of thing you are prone to believe, then you can get a very rosy story from the actual practice of an entire nation in phasing out nuclear and trying to deal with climate change. I've talked at the level of an individual building about my own experience from Greenwatt Way, and then globally, we're, of course, having to rely on modeling studies. And here in the US, you have one of the teams that's working on this in Stanford and Berkeley, one of the best modeling teams on this subject in the world. And they are of the opinion that we could, if we wanted to, if there wasn't the opposition that we faced from the incumbency, and we were left unfettered to mobilize these survival solution technologies, we could get to a 100% powered, renewable powered world as soon as 2030. And if we were to do that, we wouldn't be mobilizing any one technology any faster than we have already, through our own ingenuity, mobilized technologies through the history of commerce. Now, the closing thought is an obvious one for you guys. We've heard how important the built environment is in all this. Ergo, architects are going to be a very, very important part of the fight for Renaissance, not just in individual buildings, but in the way that buildings link up in terms of energy and other use of infrastructure in cities and developments. And that, I hope, is something that you will all join with. And I hope that I've left enough time at the end of this talk for the upside analysis, because I genuinely believe this upside analysis, you know, despite the enormity of the problems that I've tried to articulate in the systemic risk-taking by the energy industry, that together we can work in the next couple of decades on a road to Renaissance, and actually by the time people like me reach the end of our natural allotment of years, we can actually see that that is where we're going to end up on the massive balance of probabilities, with Renaissance, not ruin. Thank you very much for listening to me.